Hello. In this video, we'll be going over equity investment using the fair value method. So an equity investment is when a corporation buys stock in another corporation. So if Apple buys stock in Microsoft, they will have an equity investment on their book. There's critical events over the life of investment, of an equity investment, and they are that you need to account for. Number one is purchasing the equity security itself. Number two, if you receive dividends, how they are recorded. And number three is depending on the holding, what kind of holding you have, if you need to true it up to its fair value. And number four is when the investment is sold. There are three categories for equity investments, and they're characterized by how much influence a corporation has over the corporation that they are investing in. So if an investor does not have significant influence, which they characterize as that they typically own less than 20% of the voting stock, then you use the fair value method that we're going to discuss in this video to account for that investment. If the investor, right, the buying corporation, has significant influence, which is characterized as typically owning between 20 to 50% of the stock, then the accounting is done using the equity method, which will be covered in a different video. And if investor controls the investee, right? So then they're considered to have more than 50% of the voting stock, then they have to consolidate their financial statements. That is not covered in any of the videos in this class. That is more for the advanced accounting class. So let's talk about what constitutes significant influence, because if it's between 20 to 50% ownership investment, it's considered, a company is considered to have significant influence versus under 20% is not significant influence. A company can have significant influence over its company they invest in, even if it's under 20%, if it has one of these other factors. If it has a seat on the board of directors, if it's technologically dependent upon that the other corporation, or vice versa, if any one of them is technologically dependent on one another, if they have, if they share any sort of managerial personnel, or if they have any material intra-company transactions, or any sort of contracts with one another where what company A has to buy material from company B, then that could make it have significant influence. Or if a company if company is investing company B, and even if it's under 20%, but they have participation in any of their decision-making policies, that could be determined to be significant influence as well. This video is going to talk about when an investor does not have the significant influence. And so typically that means 20% or less of their voting shares. Let's go through an example, because a lot of it is really similar to how we account for trading securities when we invest in a bond. Okay, the following events during 2027 and 2028 pertain to United Intergroup's investment in the common stock of Argent. So we know it's an equity investment. On July 1, they purchased common stock for $1.5 million. On December 31, they recognized investment revenue for the $75,000 cash dividend received from Argent. On the same day, they record a fair value adjustment to recognize a decline in the value of their stock investment. And on January 5th of the following year, they sell the stock for 1.446. So let's go through each one of these. So on July 1, when they purchase the investment, they're going to debit investment equity securities for 1.5 credit cash. On December 31st, the company paid dividends. So this is many public companies pay dividends to their shareholders, which are their investors. And so in that situation, the investor would debit cash for $75,000 and credit dividend revenue, and that's going to go on their income statement. At year end, also, the investor is going to true up the investment balance on their balance sheet to fair value. And we've seen this in previous videos where, we use the fair value adjustment account. So here, December 31st, United has an investment in Argent, and they paid $1.5 million for it back in July. And on 12/31, the fair value has decreased to 1.450. They're going to report this investment at its fair value on the balance sheet using when you have under 20% ownership or do not have significant influence over the other corporation. So we need an adjustment to reduce this investment by $50,000, and we're going to do that using the fair value adjustment account. This is an asset account, and it's like added to the investment account on the balance sheet, right? So on the beginning balance of this fair value adjustment is 7/1/20. On 7/1 it was 0, and the balance that we need on 12/31 is a credit of $50,000. So we need to credit the fair value adjustment for $50,000, and just like we do with when we have a debt investment using the trading securities, meaning very short term, any gains, unrealized gains and losses are recorded in the income statement and affects net income. In this situation, we have a credit to fair value, so we're going to debit loss on investment, which is unrealized, and it goes on the income statement is reducing our net income. We're going to have a debit of $50,000. When we sell the investment, right? So on January 5th, 2028, we decide to sell it. And at that point, the fair value is 1.446. And we're going to first we're going to true up, we're going to adjust our balance to the fair value, and then we're going to record the actual sale and remove the investment off of our books. So the beginning at 1/1/2028, our fair value adjustment account has a credit of $50,000. What we need it to be is a credit of 54, because our cost is 1.5. The fair value on January 5th is 1.446. The difference between those two is a negative 54,000. So on 1/5/08, we need our adjustment to be our fair value adjustment account to have a credit of 54,000. So what are we going to do? We're going to record the difference to get us there. So if we credit our fair value adjustment by 4,000, we will have a credit balance of 54,000. The debit to that account, to that adjustment, will be a loss on investment, which will still unrealized because we still have not yet sold it. This is like right before we sell it, we're going to book this entry. And it affects our net income. We're going to debit 4,000 to the loss on investment account. Now we can record the sale, and since the fair value is 1.446 and that's what we sold it for, we received cash for that much. Our investment in the equity security, what we originally booked it for, was 1.5, and now here we have in the fair value account, we have a credit of 54,000. We need to zero that out. So we're going to debit the $54,000 to the fair value adjustment account. Notice that on this second entry, this step 2 entry, when we record the sale, there is no gain or loss recorded. And that's because we have essentially recorded in this situation, the loss, over the period of time, every time we adjusted our investment to its fair value, at that point in time, we recorded a loss. So in 2027, we recorded a loss of $50,000 right here. That was in at the end of 2027. And then we recorded another $4,000 loss on January 5th of 2028. So when we record our actual sale, we don't need to record any sort of losses because they already have been recorded over two periods. Now, let's just say, just for the sake of example, on December 31st, let's just say we haven't sold our investment in Argent and we've kept it to December 31st, 2028. At December 31st, 2028, the fair value is 1.3 million. Our cost was 1.5, fair value is 1.3. So we need our fair value adjustment account to be a credit of $200,000. What we would do is we would look at our ending balance from the prior year, which was a credit of 50,000. Now we need it to be a credit of 200,000, which means I need to credit this account for $150,000 at the end of 12/31/2028. So here would be my entry: credit fair value 150, debit loss on investment, going to the net income 150. Okay, let's talk about the financial statement presentations for equity securities. The equity investment for which the investor does not have significant influence, so that means under 20%, gets classified this way on the balance sheet. They are classified as either short-term or long-term, depending on how long the investor intends to hold those stocks as investment. And those that are held with intent for short-term profit are normally treated in the operating activity section of the statement of cash flows. So that's also for under 20%. When you look at the statement of cash flows, it's going to be in the operating section. Similar to how we treat debt investment using the trading securities method. All other current equity investments and all long-term equity investments are going to be classified in the investing activities in the statement of cash flows. Meaning that even if you have under 20% investment in another company and you intend to hold it for the long term, it is going to be classified as an investing activity. It's only recorded as an operating activity when it's a short-term equity investment under 20%. And then as far as the notes to the financial statement, the disclosures, if you have equity securities, no matter what kind, that you have unrealized gains or losses for the period, you need to disclose those in the disclosure notes. And if you have an equity investment where fair value is not readily determinable, those how you calculate the carrying value needs to also be disclosed in the notes to the financial statements. The fair value, typically if a company buys stock in a publicly traded company, then the fair value is readily determinable because it's on the stock exchange. But not all company, a company can buy stock in a private company that's not publicly traded. And in that situation, fair value is not readily determinable. And there's just various ways to calculate that. And that needs to be disclosed in the financial statements as to how that came about. Let's do a concept check. Which of the following is false about the sale of an equity investment? A, all changes in an equity security's fair value are reported in earnings as they occur. That's true. And therefore, the sale of an equity security does not necessarily give rise to gain or loss. That's true too, because we've already recognized any gains and losses in the prior periods. So that's not it. B, a debit to cash is recorded for the sales proceeds. That's true. When we get cash, we debit cash. C is securities should remain on the balance sheet at amortized cost after sale. That is not true. That is false, because when we sell a security, which is the investment, we're going to credit that investment to get it off of our books. So C is our answer. That is false.